Hello investors and traders, today I'll speak about 3 best dividend stocks to buy right now. So dividend stocks are stocks for companies that make regular distribution to their shareholders, usually in the form of cash payments. Dividend stocks can be a useful source of income, but the best dividend stocks can also be excellent ways to increase your wealth over the long term. The Dividend Aristocrats list is a great place to find the top dividend stocks. Dividend aristocrats are companies that are both in the S&P 500 index and have paid and raised their base dividend for at least 25 consecutive years. So today I choose the 3 best dividend aristocrats to buy right now, and let's start with the first company for today. It's Valgrind Boost Alliance with the ticker WBA. Let's have a look on its chart. So we see that now it currently traded at a level of $30 per share, dividend yield more than 6%, a very impressive dividend yield. So here I see impulse, it's a impulse here, correctional one. So the first wave, the second, the third, the fourth and the fifth. So we're very close to the finishing of the fifth wave. By the way, we can see that it's some kind of range when we traded and the lower border of this range. Also here $30, it's a major support level since 2008. So actually I think $30 can be a nice level to buy the stock company. WBA is one of the largest retail pharmacy operations in the world. WBA turnaround plans are bearing fruit. The company has cut expenses by billions of dollars, and its efforts to become a more integrated healthcare company are paying off. Added together, and this profitable company is set to become even more profitable. Management recently raised its long-term target of its US healthcare segment. Let's have a look on the fundamental of the company. So market cap $25 billion, the dividend yield 6.4. Now we see that the PS ratio is less than 1, so the stock, the valuation very cheap, very stable business. So for the rest, of course, it's not growth story. It's just a very stable business that can pay you nice dividends. Most of it the revenue, if you'll check the revenue breakdown, the company earned from the pharmacy sector. Also the retail sector can give you 25% from its revenue, and most of its revenue earned already in the US. So we see that the dividend yield here is 6.4%. Company pay and increase its annual dividends 47 straight years. So that's a lot for dividend and value investors to like this company. So let's move to the next stock for today. Is Chevron with the ticker CVEX. So oil is back, and over the past few years oil stocks have rolled back to the forefront. The energy sector has been one of the best performing since the coronavirus pandemic, and Chevron has been a big winner for investors. But if we are being fair, Chevron has actually been a pretty solid stock to own, especially for dividend investors. For years it's generating strong cash flows and growing the payout modestly every year for over 35 years. The stock price can fluctuate a lot with the ups and downs of oil price, but over the long term owning CVX has proven a profitable investment for dividend seekers. If we look at the charts, so since 2020, since the pandemic lows, we are trading in the uptrend. So before we break this trend, it's hard to start to tell that the trend is broken, and we can see a more significant stock decreasement. The dividend yield here is very close to 4%, and of course let's have a look on the financials and the fundamental parameters. So market cap $300 billion, dividend yield for me very impressive. The valuation now, the P ratio is cheap. The average for S&P 515 is here is only 8, and the PS price per revenue about 1.3, also very cheap. Look, after since the pandemic, the revenue of this company bounced very significant, and the revenue showed increasement more than double, and also the marginality. For the last report, net income margin 15%, so quite enough. The company work in the downstream sector, upstream, and all other sectors. Most of it, by the way, it's more international company. The US segment give the company only 45% from its revenue. So here, look, the payout very low, 30%. So here I see even room to increase the dividend payments. And as I told you previously, 35% of dividend consecutive increasement. It's very good for dividend investors. By the way, the company decreased its level of debt. Look, a few years ago it was 48 billion bucks. Now it's about 27. The Fed fund rate is 5.25%. We live in an environment of elevated interest rates, so of course it's a good position and good view for the management of this company. And let's have a look on the last stock for today's Target. So for years, Target has proven more profitable than its peers by posting some of the highest gross margins and operating margins in retailing. At the same time, it focused on increasing its e-commerce business and expanding in-store offering has kept sales growing at a solid clip. However, 2022 was a brutal year for Target company, with very high expectations clashing with the challenging retails of retailing and sending shares of this company down more than 30%. So yeah, by the way, from its hot level we are down about 48%. Despite a tough year, Target remains one of the best run retailers out there and a solidly profitable company with a dividend growth at 50 years and counting and shares trading for a steep discount to its all-time highs. Dividend investors should put Target on their watching list. So from the chart, by the way, the RSI, the momentum indicator on a weekly time frame, we see that RSI 34, so it's telling us the stock already oversold. So it can be a nice time to buy the stock. Look, the dividend yield more than 3%. Let's have a look at the fundamentals. Market cap 63 billion bucks, dividend yield more than 3%. The valuation, price per revenue, very cheap. The PE, price per earning, is 20. Yeah, not cheap, but anyway, don't forget that you receive a 50% price discount of its shares. The revenue of the company is increasing. It is a good point. The marginality, by the way, it's for the last, historically, it's this company is not. It can impress you with high marginality, 4%, 6%, 3%, so nothing special. The revenue, all this 100% earned in the US, and of course 50% of dividend history. It's a great figure, and don't forget that the payout is about 70%. So I see here good room for the company to increase its dividend payments. And let's have a look also on the expectation EPS, earning per share. It's expected to grow, and the revenue itself also we see a slight growth here for the last for the next years. So in my mind, Target also can be a nice dividend aristocrat that you may now add and to your dividend portfolio, and of course receive a nice and juicy dividends. So of course, if you like this video, don't forget to subscribe to my channel, press the like button, and see you the next time. Bye.